Hey guys, welcome back to this session. For those of you who aren't aware, we just literally finished up off our Darwin explanation session about 10-15 minutes ago. So welcome back for the guys who were in that session. What we're going to take a look at now is a little bit more chilled. It's a little bit more interactive. We're going to do some strategy development stuff. I'm going to ask for somebody as kind of a volunteer from the audience to provide me with their Darwin ticker, and I'll use it as the example in this session. So what I'm going to be doing is taking a look at some statistics. So I'll run through some metrics that we provide at Darwinex 0 and some metrics that we provide at Darwinex as well. Because if you're not aware, we also give you access to view your Darwinex 0 Darwin through darwinex.com too, where we have a few different metrics for you to take a look at. Just want to get set up because it's absolutely boiling hot in the UK right now, and I can't be sat down. So yeah, if there's anybody in the audience who would like me to take a look at their Darwin and like me to do some public analysis on it, then please let me know. If not, I will pick a Darwin at random, and we can do some more from like an educational perspective as opposed to me doing one live. I'll make sure the guys in Discord will be able to see StreamYard at the moment, so just ignore that for now. I'm just waiting to see if anybody puts their hand up from YouTube, Twitter, or Instagram in terms of putting their Darwin forward. I'm not expecting today's session to be very busy, to be honest, because it's Juneteenth holiday in the US, so a lot of our US guys will be having a bank holiday, and to be fair, it's probably the worst day to do these sessions today because the US guys are going to be out on bank holiday. Anybody in Europe and the UK right now is going to be going out after work and enjoying the sun. So might even just do kind of more of a shorter educational version of the usual session that we do. Unless there's somebody in the Discord or YouTube or Twitter right now who wants me specifically to take a look at their Darwin and take a look at their metrics. If so, speak up or forever hold your peace. We're also just looking at a trade. Well, I've got trading view on my screen at the moment. It's a trade that I'm currently in. But again, it's bank holiday in the US today, so I'm not looking at anything major. David, thank you very much. David from YouTube has said you can look at MAQP. Thank you very much, sir. I will get that over now. MAQP. What I'll do for you guys on Discord as well, I'm going to change the screen that I'm sharing just so that you can see exactly what I'm looking at and not look at StreamYard. Just because the comments are supposed to pop up on StreamYard, but they don't for some reason. It's quite annoying, but okay, so first things first, I don't usually take a look at strategies that have less than 6 months. Just because I don't think you get enough data to really get a feel for the system unless you have a significant amount of trading data. So let me take a look at how many trades you got. Okay, yeah, it's fine. You got 1,000 trades, which I'm presuming this is automated. If not, that's you're one busy guy. So yeah, I'm presuming this is an automated strategy or an automated portfolio of strategies because just due to the sheer number of trades. But I would say even though you've got less than 6 months data, 1,000 trades is kind of good enough in my opinion to start getting some insights. The important thing is to match up the insights that you have now from the live trading to kind of back testing periods in different market conditions. So take a look at performance through different market cycles, i.e. when interest rates are high, low, when the Fed are hawkish, when they're dovish, all these different things, and make sure that your system is reliable through all different periods. Okay, so this strategy is an EA, but it's manually controlled. Is it just a one EA or is it multiple? Like, do you have multiple strategies all running together? Because even for one EA, 1,000 trades is a lot. How many is that per day? Yeah, 15.5 trades per day. One EA. Whew, okay. I'm presuming it's not in. Oh wow. Okay, so this to me looks like maybe not a martingale or a grid, but probably just pivots in, like clips one position a load of times. Is that correct? I mean, it might be grid or martingale, which You might find that your VAR takes a hit for that, but it doesn't look like it is at the moment. Your excursions looks like it's a bit of a gridder. Yeah, let me know if it's grid or martingale, because it will kind of aid me as I'm going through it, just so I'm aware of how it performs. But all green so far, so 4 solid months. Nice return, 8.7 return over a 4 month period, fantastic. We haven't got enough data for these to be reliable, so you definitely don't have a Sharp of 3.6, and you definitely don't have a Sortino ratio of 3.58. But with limited data, we don't have enough data to accurately calculate that. Very low risk martingale, if that's possible. Yeah, I mean, it's possible. I've used martingale systems before that are very low risk. I'm talking like, absolute worst case scenario, they go to like 2-3% account drawdown, but then they don't make enough, or that system didn't make enough to make it worthwhile. And there's always a risk of, an eventual martingale blow up. So just be aware of that. Generally, the Darwinex risk engine isn't very martingale friendly, but it doesn't seem to have been affecting you too much, probably because you're running it at such low risk. And the reason for that is because it kind of works against the idea of a martingale. So with a martingale strategy or a grid strategy, essentially what you're doing is when you're going into drawdown, it begins adding size, so it begins adding risk or exposure to that specific trade. Now, what our risk engine is doing is measuring your deleverage in that position, which doesn't just measure it when you open the trade, it measures it whilst you're in that position too. So if your deleverage starts increasing whilst you're in the trade, it's going to then begin to start reducing the exposure that you have on that position. So for example, let's say one of the trades goes into significant drawdown and your system keeps clipping it and increasing the exposure. At the same time, the risk engine at Darwin level is going to be reducing the exposure. So eventually when the trade closes and the martingale's worked its magic and it comes out of the drawdown at signal account level and closes for a profit, you might not have enough size on at Darwin level to still come out at a profit, if that makes sense. Now, it doesn't look like it's affected you too much to this point, but just be aware that you might run into an issue if your account goes into a decent drawdown, like something you haven't experienced before, but your Darwin doesn't recover from that drawdown in that single trade. I'm talking on a trade by trade basis here. It could be due to that. So the risk engine might have been reducing your exposure, which completely negates the martingale's effectiveness. Didn't think of that. Again, usually when people come in with martingales, they blow up within a month because they see martingales as free money and stuff. But we do have some successful martingale traders at Darwinex, I won't lie. But they all understand this notion, and they all know that, there will be trades where the martingale can't work out of it because it can spiral too much. So just be aware of that. So you have almost half your activity is on indices, 15% on commodities, and 32% on FX. Pretty high win rate, but that's to be expected with a martingale. So pretty much with a martingale system, if anybody's here that doesn't understand what a martingale is, it's basically where you will just keep buying a position or selling a position, and if it goes into drawdown, you'll buy or sell again. Your targets get smaller and you just keep adding size. So let's say you might start with a 0.01 lot, then the next trade it's also a 0.01 lot, then after that it might go to 0.02, then a 0.05, then a 0.1, and your size increases with every trade, so that you don't have to. Initially, you might be looking for 30 pips. The second trade, you might be looking for 25 pips. And then eventually, when you've got a large amount of size, you might only be looking for a couple of pips. But what that'll do is, the last 2 trades it enters might negate the losses for the first 3 trades. So technically, it's a 100% win rate strategy when you look at it on a position by position basis. But on a trade by trade basis, of course, there's always going to be losers and winners. Now, it's not always a 100% win rate strategy, martingaling in general, because there's a high percentage chance of martingales to blow up at some point. There's one Waka Waka that was running for I don't know if the track record is public anymore. This was a famous one. It looks like it is. The Waka Waka EA. Some of you have probably heard of it before. So this has been around for probably 6 years, maybe 6.5 years. So since June 2018, and it had, this is going back till pretty much just over a year ago. I think its max drawdown was like 12%, 15%, and then all of a sudden, in 1 month or in less than a month, it went through a 70% drawdown. Now it did recover and survive, but at that point, I remember watching this live. There was a significant amount of risk on the table, and it actually looks like at the master account level, the developer deposited more capital, which is likely to avoid a margin call. And so, yeah, there's just always that risk with martingale strategies, and I use Wacker as an example. And this isn't directed towards you, David, at all. I'm just telling people about martingales and about the risks that come with them. Of course, if you'd have looked at this track record for 5 or 6 years, you'd have gone, "Oh, it's all fantastic. No need to worry." But then in 1 month, there was a 70% drawdown, and I think it was short New Zealand CAD. Again, it's a famous strategy. I've used it myself in the past, and it's brilliant when it works. But then again, this drawdown was is just something else. So just be aware of that. These things can happen, but it can also happen with manual trading. Right, traders can blow up their accounts all the time. I will manually close out a bit quicker. The EA is called Profit Retriever. That would have been on JPY, I guess. No, the Wacker strategy was on New Zealand CAD, Aussie CAD, and Aussie New Zealand. The EA is called Profit Retriever. So I'm presuming this is an EA that you can get online, and then you just adjust the metrics. So you change the metrics based on the assets that you're trading, and then input the parameters that you have. But yeah, your win rate's pretty solid. I mean, positive return on all assets, and what I quite like with it is it's very linear. So quite often what I'll be doing is when I'm looking at somebody's return by asset, you might have the commodities, for example, in this case, where it has the smallest portion of your trading activity, but it might have a higher percentage return than the other assets. And at that point, you start to look at things like implementing a risk barometer so that you're pushing size a little bit more on assets where you trade better or where your system is more applicable. But again, and this goes to a martingale strategy again, because it's not really a strategy per asset. Kind of, it has the same instruction depending on, no matter what asset it's on. It's kind of buy this level, buy a little bit more if it goes into drawdown. Of course, you might change the parameters of where. And again, if you're implementing some bias on top of that, fantastic. So you're not just letting the system kind of get out of hand. But the return based on the amount of trades is pretty linear. So there's not too much to say on that. Your trading time distribution, this doesn't really matter for you because it's automated, and B, it's a martingale. So you won't be switching it off if it's on drawdown. You don't want to be getting out of those positions that are going to save you. So even though you have a negative return through the Asian session, that might just be when it closes the trades, but it's closing all of your positions. So I wouldn't be worrying about that too much. But again, generally what I'm looking at here, and this is more for the guys who execute manually, is there a bit of a disparity on your performance based on time of day? So do you perform, in this case, like, there's also a second disparity here, which I'll talk about now. But do you underperform in one session over an extended period of time where you overperform in the other two sessions? For example, you're positive in London and New York, but then you're negative in the Asian session. Well, would it not make sense to not trade the Asian session and to only trade within these specific hours? Now, it comes a little bit harder to make that decision when you're an automated trader, purely because you don't know when your signals are going to pop off and it's trading for you, right? But you can still refine it. Like, you can still decide to cut down your EA to a specific time of day. I myself have EAs that only operate within certain hours because of this specific reason. Now, the second disparity here is you have almost half of the trades in the American session of the European session, but you have a higher return. So again, it's one of those patterns that I was on about with the assets. So less trading activity, and where it says number of trades, is actually trading decisions, so opening or closing of a position. So whilst you've got half the trades, you've actually made a higher return. Now, what you would expect if the system is linear in its approach, you would expect its return to be linear based on all the different variables. But what you find is strategies are often often suited to different variables that you wouldn't think about. For example, day of the week, time of day, different assets, like whatever you can think of of a specific variable can affect that strategy's return or that strategy's efficacy. For you specifically, David, there's nothing really that I would change here because I don't think it's really applicable to how you approach the market or how your strategy is going to be acting. But again, what I would be looking for in any of these is just patterns that you could exploit. So where you know that you overperform, okay, is there something that you can do about that to keep performing at that level or to kind of squeeze the towel for any juice left? Again, going back to the risk barometer idea, it's one of my favorite things to talk about. The guys who attend these sessions on a weekly basis will know I bang on about this all the time. But finding out your expected value based on every trade is like a cheat code, right? When you know when to push a little bit more size or when you know when to scale back a little bit more size, can be really beneficial to your growth as a trader. So, for example, in this specific example that we have on the screen right now, where we're looking at the trading times, we can tell clearly from this data that the strategy works better in the US session. Again, it's hard to judge specifically on this strategy because it's a martingale, but that aside, it's generated a higher return with less trades. Okay, so our expected value based on this one variable is higher in the US session. So can we squeeze that towel a little bit more? Do we have the room to increase our size slightly? I'm not talking about doubling risk or tripling risk. I'm just talking about slightly pushing our foot on the gas, maybe increasing the risk slightly or looking to see if we're leaving money on the table, tracking our maximum favorable excursions during this specific session on this specific variable and seeing if we can really squeeze that. Now, on the flip side, in the Asian session, where we know that this strategy is less profitable, can we cut trades sooner? Can we reduce trade size? So instead of trading a 1, like a 1%, for example, we might trade a 0.95 or a 0.9, just slowly lowering it down. That would be on NDX. I presume you mean, actually, I don't know what you mean. That would be on NDX. Yeah, let me know what you mean by that. Then the last metric on this page, which is one of my favorite. I love this metric, and I think it's often something that a lot of traders ignore, me myself included, and it's the return distribution by day of the week. Now, this is included in your trading behavior, if that makes sense. Like, it's not necessarily just the strategy. Like, if you're implementing your discretion, of course, this is going to be biased towards your decision-making ability and your decision-making skills and how you've approached the market over the past X amount of months/years. So we do have to account for that. However, I'm going to bring up THA, which is our highest, our most successful Darwin, currently managing $23 million in investor capital through Darwinex, not Darwinex Zero. But we're going to look at his assets and timeframes tab. So just for reference, he has a 10-year long track record. That's his track record over the past 10 years, as you can see. So green every year, apart from this year, but we're only halfway through. Now let's take a look at that same metric. Now, before I even go over the statistics, the whys, the hows, the whats, I'm pretty sure you can all tell me that there's kind of a red herring here. There's something that doesn't add up. There's something that's kind of jumps out at you straight away. And of course, I would say you'd be blind if you didn't see it. But if we let's take a look at the traders' return per day. So on a Monday, they're down 8.37%. Whereas on a Thursday, their best day, they're up 226%. Now, the reason I'm showing you this is to show you the disparity in this one variable. Now, you can go, this trader has a 10-year track record. He has $23 million. He's super successful. He's done XYZ. He's yada, yada, yada. He's actually won 3 awards for his trading. Quality trader. Then you go on a Monday, over 10 years, he's not made money. Okay, so his expected value is lower on a Monday. Okay, well, would you take the same position sizing? Should you be approaching the market the same on a Monday as you would on a Thursday? Or should you squeeze the towel more on a Thursday? Should you take a step back on a Monday? There's a clear difference. And like I say, it's something that's often looked over by people. And again, I'm guilty of it. where we just go, this is my strategy, this is how I'm going to approach it every single day, this is what I'm going to look for. I'm looking for this specific pattern or what have you, or this price or this time or whatever it may be. But we often negate the fact that each individual day has its own unique characteristics. It's its own variable in its own right. For example, Monday, you have all the floor traders coming back to the desk after the weekend. They're going to be looking for the positions. They're going to be analyzing geopolitical risks from over the weekend. Okay, what do I need to do for the week ahead? What's my end of week target? So how am I going to plan for the following week? Right, and that's on a Monday. Are they going to be taking the same trades, or are they going to be approaching the market with the same behavior? And I'm talking at professional level here. So guys who approach the market like a professional, or guys who are working in an institution, whether it be a prop desk, hedge fund, investment bank, you name it. On a Friday, when they're winding down and they're not going to be holding the trade over the weekend, because remember, some of these guys are trading with insane amounts of size and they don't want to take that weekend risk. Are they going to be approaching the market the same on that Friday as they are on the Monday? Of course they're not. They're not going to be looking to run a 500 tick move over the course of the next week because it's a Friday afternoon, let's say. And so their behavior is going to be different. Their ideas are going to be different. And therefore, that in itself is a unique edge on a Monday and a unique edge on a Friday. Completely different days. But a lot of people will put that to the side, which I'm not saying is the wrong thing to do, but they will focus only on one variable, which is the technical aspect or the technical analysis. They'll go, here's a pattern that I found, and I'm going to trade that every single time that I take it as my common denominator in my trading plan. I see ABC, I do XYZ. And they're ignoring all of this information around them. I get really frustrated with, and I'm going off on a bit of a tangent here, so I do apologize, David. We'll come back to your Darwin in a moment. I get really frustrated with traders who say, I'm a technical trader only, I don't need anything else. It's charts before anything, whatever. You know the score, you know what I'm talking about. I get really frustrated with it because there's 1,000,001 different variables that you can bring into your trading, and you're using one and saying all of this other stuff doesn't matter, but you're ignoring all of the stuff that is factual, or all of the other stuff that could improve your trading. Charts are a byproduct of everything else, right? Macro traders say charts don't matter. Technical analysts say macro doesn't matter, but really there's a bigger meaning as to why an asset's moving. It's not all based on speculation. I mean, a lot of it is, but speculation is driven by something. Okay, central bank stances. Okay, the interest rates. What's employment like? What's inflation like? There's so many things going on behind the scenes that matter, which would then affect a chart. Again, bringing it back to why I'm saying this is it affects that one variable, which is your TA or your technical analysis. So don't ignore all of these other variables that will just improve your technical analysis. And what I mean is, if you're hunting for key levels, or you're hunting for stop hunts, or whatever you want to call it, whatever your strategy is on a chart, you can fine tune that by finding these variables and seeing where you have the highest expected value. For example, THA, is his expected value the highest on a Monday, or is it the highest on a Thursday? Of course, it's highest on a Thursday. So on a Thursday, I would expect him to be going into his office on a Thursday morning, ready to kill the day. Whereas on a Monday, I would presume he comes in the office, he scans the markets, he probably takes a trade because, he probably always will, to stay sharp and to maybe get exposure to a move that hedges against a poor Thursday on that specific week, whatever reason. But I would expect him to be a different man on a Monday to a Thursday. I'd expect him to be a teddy bear on a Monday, but a soldier on a Thursday. And all because of this one variable. Anyway, to bring it back to David, there's not too much disparity between your daily distribution in return, and I wouldn't expect there to be with how you approach. Again, going back to martingales, they are very consistent in their approach. Of course, the risk is completely non-consistent because some trades you might have a 1 lot, another trade you might have a 10 lot, for example, and you can't really control that. But all the behavior behind a martingale is super consistent, and it's super foreseeable. Like, you know how it's going to act, you know how it's going to enter, and therefore your distributions like this over time will level out. It's why I'm saying, like, This is only 4 months worth of data. In 8 months, I'm expecting them to be tighter and tighter and tighter and tighter. I don't think you'll have one like THA where you have an outstanding day and then the rest are less effective. Classic martingale, negative payoff ratio. I mean, I wouldn't expect anything less, and the only reason for that is because your average losing trades are going to be bigger than your average winners. But that's looking at it on a trade-by-trade basis and not a position-by-position basis. So what I mean by that, the difference between a trade and position, a trade is a singular buy or sell in the market, right? So if you buy now, that's a single trade. Whereas if you bought 10 times, those 10 positions are combined to build a position. So it's 10 trades, but one position. So even though here you have a negative payoff ratio trade by trade, your position is still going to be positive. Again, this is like typical martingale behavior where your losing trades take longer than your winning trades because it will get in and out of winning trades, whereas losing trades, it will sit it through the drawdown and start adding more size. Duration versus profit. Again, this is very difficult to provide analysis for when it comes to martingale because this is where you're going to be hunting for new levels of expected value again. So you're of course going to have more wins the less time that you're in the market. Nature of martingale, you get in for small moves, small winners, small winners, small winners. So you can see in this in these two boxes here, they add up to 156. So that shows any trades that you've been in for less than 30 minutes, you've won 156 of them, whereas you've only lost 38. So that's your hot zone. That's your most profitable zone, right? Whereas the further we go up, if we take a look up here, if you've been in the market for over 5 days and 8 hours, you've lost 6 trades, you've won none. You have 100% negative expected value here until we get the data, of course. Like I'm not stupid enough to think that this might change over time, of course, but until we have that data, it's 100% negative expected value. Here, between 2 days to 5 days, you've only won 2 trades, whereas you've lost 16, you've lost 18. So again, you're massively negatively skewed on your expected value here. But all of this is negated by the fact that the strategy in nature is a martingale, and therefore it kind of uses math to come out of drawdowns. I'm not advocating that approach for the majority of people. However, you seem to be making it work thus far, so I'm not recommending you change anything right now. Your maximum excursions are, I'm not going to lie, pretty ugly, but again, that's to be expected with a system that does this sort of behavior, which is where it adds size, because there's no cap to your downside, but there's usually a pretty small cap to the upside. So we can see on the majority of bars, your maximum favorable excursion, or positive excursion as we call it, is much smaller than your negative excursion. So the green side of the bar is much smaller than the red side. And that's because martingale strategies let the trades breathe, it lets it sit in drawdown, and then eventually close it with a small amount of profit. So you will get these outliers here where price moves against you massively. That would probably relate to this drop-off in equity here, because that's your steepest drop-off in equity over there, which was, I mean, from the peak, it was 6.81, but that looks like about 4% drop-off in equity, which I'm presuming was from this trade over here, along with a couple of other trades. And again, it worked its way out of it, but of course, you still have to be aware of the equity drawdown because you can still blow up an account with equity-based drawdown. Your median positive excursion is 0.03, median negative excursion is 0.02, which is actually positive, so that's good. With your best positive excursion being 0.73% and your worst being 2.64%. Now, that's not good because your worst negative excursion, which means the furthest a trade went against you, was probably what's that, like almost 5 times as bad as your max positive excursion. Can you extend your targets? You know, this could be something that you look at in terms of counteracting the martingale nature, is trying to run trades when you get into a good position and like managing the risk yourself. So instead of capping it like a martingale would, seeing if you can run those trades. That's a potential thing for you to look at improving, but you have to understand what's your maximum positive excursion. on 1,000+ trades, it's going to be very, very difficult to look at it on a trade by trade basis. So I don't even know how I would approach that, to be honest. Maybe run some back tests. If you've got the code, the source code of the EA, maybe run some back tests on it, see if you could extend the targets and see if it would make a better return. The problem is, if you start doing that, it can completely change the whole strategy, because the trade frequency will be less, and it might get into worse drawdowns and struggle to get out of them a little bit more. So again, it's super intricate, and just play around with it if you can. Your VAR is quite stable, although it had a massive jump up here towards the end of April. So you were sat pretty stable between 5 and 7%, which isn't too concerning. And then it shot up to 12, which again isn't a massive increase, and I'm not too concerned about that. I don't know if you added another asset in or if you increased trade size maybe, but I still wouldn't be too concerned about that. But then ever since then, it's been pretty stable. So that's the one thing I will say about your value at risk. It's not too important whether it's high or low, but it's how stable and consistent is it. Anything over 30% is a cause for concern. What we've seen over the past 13 years of Darwinex being alive is that any trader with a VAR of 30+% is kind of destined to blow up at some point in time, whether that's a full account blow up or like a whacker 70% drawdown. I was actually warned by the guys at Darwinex about whacker. We were talking about it the once, and they said that's going to either blow up or go through a massive drawdown at some point. And I was like, no, it's had a 5-year track record. There's no way it's going to happen. And then bang, within 1 month, it saw a 70% drop in equity. And that's because the VAR was so high. And so when I say that, I'm not saying it just because we don't like strategies with VARs above 30. It doesn't make a difference to us because we risk adjust your Darwins anyway. All we're saying for trader protection, so for your own protection, is just be aware if your VAR is above 30, you have a high chance of blowing up at some point. I've just seen in the Discord as well from Jimmy. You said, could I do EZDK2? I won't be able to do it today, but what we can do is we can either do it next week in the next week's session, or if you need it before then, if you want me to do like a video for you, I can send you a video recording doing this, in private or one-to-one. So just let me know what you prefer. Next week is okay. Okay, perfect. Yeah, just make sure you turn up next week, and I'll do this session for you. Now, what we're going to do now is we're going to head over to Darwinex.com, and we are going to take a look at Darwinex.com. We're going to take a look at the statistics that you get on Darwinex, because some of them vary, some of them are different. And I think it's important to take a look at these. Now, anybody who's unaware, you can log into Darwinex.com with your Darwinex 0 username and password. Of course, there's going to be country restrictions because Darwinex is our regulated broker entity. So I think guys from the US, although I know it's possible to access, if I can't say why, because I don't want to be I don't want to be seen to be soliciting bad behaviors, but I know there's guys from the US who basically say they're not from the US and they get access to this. They can't invest, but they can view metrics on here by doing so. But if you're from anywhere else in the world, you'll be able to access just using your Darwinex 0 username and password. And this